Option contracts sometimes suffer from a liquidity crunch, especially in India. A lot of stocks have option chains which are just not tradable because there are not enough buyers and sellers. Let's talk about this a little bit. The bid-ask spread is the spread that the best bid and the best ask have the difference between. The bid is the best price a person is willing to buy at, and the ask is the best price a person is willing to sell at. The bid is obviously lower and the ask is always higher. Now, if you go to a sabzi mandi, for example, if you go to a sabzi mandi today, you'll find many hawkers, say, selling watermelon. You can usually bargain and get the best price because the hawker has competition. There are many hawkers selling the same product, that's the watermelon. This is a liquid market. Why would you pay 51 or 52 if one of the hawkers is willing to offer at rupees 50 per kg? Basically, more buyers and sellers is always a good thing. It's a liquid market. It's easy to get in and get out of the market because there are a lot of participants. Now, just the opposite is called an illiquid market. Now, taking the same example, if there was one hawker selling an exotic fruit, say the mangosteen fruit from exotic old Singapore, and he's offering it to you at a certain price, it's a little difficult to bargain because there is no competition, and this is an illiquid market. There's only one seller and probably maybe one or two buyers. So this is a market which is called illiquid, and the less participants a market has, the worse it is for traders. Nifty and Bank Nifty have some of the best liquidity rates out there, and you can trade them very well because you can easily get in and easily get out. Let's see a real example of Voltas. So this is Voltas. It's the 24th April 190 strike price call option. And you'll notice that the contract costs 35 paisa. The bid is 25 paisa and the ask is 40 paisa. This means if you wanted to exit this contract, you could not sell at 35 paisa. You'd probably get filled at only 25 paisa. That's 28% away from the current market price. Why? Because there are less buyers and sellers. The bid and ask that you see over here is too wide. Now let's look at a better option. Let's look at the Nifty and how that looks. So this is the Nifty 29th May 6,800 call. It has a ask and a last traded spread of about 30 paisa on a contract of 319. That's only 0.09%. This is liquid. Look at the ask and look at the bid. It's very narrow, and this is called a liquid market, and you can trade this. Now, this does not mean that you'll make money. It simply means that it's efficient enough for you to enter and exit with ease. Traders, this is a major checklist when you're putting on an options trade. Assuming you have everything in turn and you want to trade a certain option contract, before you put on that trade, make sure you know how many contracts were traded during that day and the last few days, and make sure that the bid and ask is very narrow. Let me show you Syndicate Bank. It's very interesting that a company like Syndicate Bank, which is well respected, has such low contract turnover. Look at this. It was really low, or almost zero. This is in the month of June, right, from 19th to the 27th. You can see sometimes it was 2, 8, on one day it was even 0, and one day it was 20. The key takeaways here is that you always want to trade a liquid market. And this is not only true for options, it's true for equities as well. It becomes easier to enter and exit a stock which has a lot of volumes and a lot of participants. So before putting on that trade in an options contract, make sure that you have enough liquidity. Low bid-ask spreads and a high number of contracts is a good thing. Look at Nifty and Bank Nifty. A lot of contracts are traded. That's what you want. And make sure that you always trade that before you put on that trade.